Hi, Louis. I just realised that I put the wrong title. I've used a previous talk for the
Uh-huh.
SciAm Mathematical Finance group, and I didn't change it to Santander. I'm very sorry about that.
No worries.
Okay, um, so let me just get the right file up. Sorry about that. I was so intrigued listening to the last talk that I lost myself in it, and I wasn't looking at my slides. Just give me 2 minutes. I'll just change this. Actually, I did have some questions, but I didn't want to interrupt um, about the shorting of Bitcoin because let me just put in Santander. You can short futures, and what I'm going to be talking about today is mainly okay, one more thing. Sorry about this. Might take long to compile. So it is possible, of course, to short Bitcoin using futures, but the problem is that it's only the CME futures that banks are allowed to trade in. Most of the activity on futures markets comes from these unregulated futures, which is what we looked at the last session yesterday on the price discovery. So, but I do agree with the previous speaker about the negative view on Bitcoin. It has no intrinsic value, as opposed to something like Ripple, which doesn't, it's not even a mined cryptocurrency. Anyway, so I think I should share my screen now, and I've corrected my slides. Can you see my screens? Yeah.
Yes, we can.
So here we are. So today I'm going to just start with a recap of options, because I noticed that when I spoke to the audience on Tuesday, quite a few people were in credit risk, and you know, options is very much a market risk tool. And then talking about implied volatility in general. And then the last three sections will be focusing more on trading and hedging volatility, and in particular Bitcoin volatility. So that's the agenda for today. No, it's not. Hang on. Typical. Okay, so there's the slides. That's fine. Adobe Acrobat. There we are. Fine. Okay, so starting with the options fundamentals. A standard European option is just a ticket that it's a bit like a lottery ticket, you know, you buy the ticket for a small amount and you either win or lose, and if you lose, you just throw it away. So it's unlike a futures contract where there's an obligation until whilst you hold the futures, or you long or short the futures, there's a financial settlement up the line. In options, it's just a right to buy, that's a call option, or sell, that's a put option, some underlying. The underlying can be anything that you can measure. It could be rainfall, it could be temperature, it could be the price of Bitcoin, for example. So the notation we'll use for the market price of the underlying is ST. We assume that's traded in a market. Although some things aren't, and that means that the whole hedging arguments are much more difficult. In order to hedge, of course, you do need a traded underlying. That would be your delta hedge. And the two characteristics of an option are the strike and the maturity. So for one underlying, like Bitcoin, there's a whole range of different strikes, K, and maturity dates, which we measure in years. And then the running time, that's from the initial issue of the option, call that time 0, until the option expires is the T. So the time to expiry, or the residual maturity is T minus T, capital T minus little t. And if the option is held to expiry, but few are, the payoff would be the maximum of the price of the underlying at expiry time T minus the strike for a standard call option, and the maximum of the strike minus KT and 0 for a standard put option. So these are easy things to draw. I also will show that in a graph in a minute. So this is a typical set of, for example, call option prices. There'll be a similar matrix for put option prices. So you have strikes. I'm assuming that the underlying is around 100 here, so that you have strikes below and above. This is a very stylized picture where you have exactly 80% and 120% of the underlying price at the moment, and various maturities here from 40 to 150 days. And so for call options, you can see that the right to buy at 80 when the underlying is 100 is much more expensive. That's 20.372 than the right to buy at 120, which is almost valueless. And also that the value of an option will increase with the maturity, because there's longer for the underlying price to change, so that the option, for example, the 120 strike 150 down here has a greater value because there's more time for the underlying to move over 150 days than there is over 40 days. So that's the typical pattern of call option prices. This graph is in your handouts that I sent yesterday, but I just moved it up here. I thought it was a bit easier to talk about it. So the bold line that you can see here, where the underlying S is on the horizontal axis, is the maximum of S at the maturity time, T minus K. So that's the bold line here. The dotted line would be the payoff to a futures, where you aren't allowed to throw your futures contract away. You do have to settle. So that's the dotted line here. And the grey lines are the prices of the option, this is call option, before expiry. And these prices could be derived from a model. I've just put Black-Scholes Merton, or Black-Scholes as you might like to call it, on the axis here, but it could be a market price as well, such as the ones I just showed you. And as the option approaches expiry, or as the volatility decreases to 0, the grey price curves tend towards this payoff here. So this light grey would be a long maturity option price curve for a fixed strike, but different values of S. You can also draw diagrams for different strikes. In particular, when we look at implied volatility, we usually put the strike along a horizontal axis. So there are various ways of looking at it. But this shows us that for a call option, it's what we call in the money. There is a positive payoff if the strike is less than the current price of the underlying. So moneyness can be measured in many ways. It's a measure of its worth if it could be exercised now. Now, of course, American options can be. Well, I'm only going to be talking about standard European options here. And they can only be exercised on the maturity date. So there are lots of different definitions of moneyness. Some just use a very approximate definition, which is just the difference between the current price of the underlying and the strike. Others would discount these quantities, and others, including myself, use a discounted ratio of S at the time, present time, and K, so ST over K, both those quantities being discounted. So let's suppose it's defined as a ratio, and we can distinguish moneyness greater than 1 or less than 1. For moneyness greater than 1, a call would be in the money. The underlying price would be greater than the strike. Equal 1, the underlying and the strike are equal, that's at the money, or out of the money when the underlying is less than the current strike. Sorry, greater than the current strike. Puts are out of the money when they have a low strike and in the money when they have a high strike. That's the right to sell, and you wouldn't want to sell at a price less than the current price. So if the strike is low, the put is out of the money and in the money for the high strikes. Now let's just a rapid view of all the fundamentals of option pricing here, and I'll just also quickly mention the Black-Scholes model too. But we need to distinguish between market prices and model prices. Once an option is issued, for example, the exchange Derivate will issue options. They're their own market maker at issue, but then there are people that are secondary market makers on the Derivate options exchange for Bitcoin, which is the largest Bitcoin options exchange. And so they can be traded on the secondary market at any time between the time of the issue and the maturity date T. So the market price, of course, is just set by supply and demand. And the model, or we can call it fair price of an option, that depends on the underlying asset's volatility. The higher the volatility, the more valuable the option, because there's more chance of the underlying price changing before the option expires. So this is very different to a futures contract, where the volatility of the underlying doesn't affect its fair value. So the study of options is really the study of volatility models, and in particular the field of stochastic volatility. So the fair price will depend on the stochastic process or the model that you use for the underlying. Now, the way we calibrate, for example, the Heston model or the Sabre model, or there's any number of different models, which have various parameters. They'll have a volatility or a vol if it's a two-factor model. And if it's just the Black-Scholes model, it's just the volatility. That's the only parameter that we don't know. But most models have many more parameters, maybe 4 parameters that we don't know. And we calibrate those parameters by taking a set of option prices as they are now, and then calculating the model prices and then fitting them to the market prices like this. We can minimize the root mean square error or do any sort of optimization we want to tweak those parameters to get as close as possible fit to this set of call option prices. In fact, we normally do it on the implied volatility, but it doesn't make a lot of difference whether you calibrate the actual prices or whether you calibrate what we call implied volatility. So that's how you fit your model parameters. But the problem with most models is that the next time you get a set of option prices, the parameters will be quite different. This is too complex for this course, but there are a lot of papers on my website, and I think I showed you how to download, particularly the old papers, you'll be able to download directly, and most of these papers around 10 years old focus on what to do about calibrating option prices if you are interested. And they're also around 2 or 3 years later, there's a lot of papers on trading volatility, but not Bitcoin volatility, equity volatility, around 10 years ago. Okay, so you all know the fair price of a futures contract. ST is the spot price of a risky asset. Assume it's tradable long and short, and it might pay dividends or have carry costs. And then the time T forward price of this asset for exchange at some future maturity capital T can be found by standard no arbitrage arguments that I'm sure all of you learnt in your undergraduate or postgraduate finance educations. And that gives you a unique model or theoretical or fair price where the price of the forward is related to the underlying or the underlying is just the discounted forward price. And I'm using the notation here, R for the risk-free rate of return, or the discount rate, and Y is the dividend yield or the carry cost, depending on whether you've got an equity or a commodity or something like that. And I'm just going to assume that these are constant. In fact, with the current environment, with risk-free rates of returns being so low, I'm going to ignore them, and you don't get any dividends on Bitcoin. This is the only, I talked a lot about other crypto assets on Tuesday, but today I'm just going to be focusing on Bitcoin, which pays no dividends. But for options, there are many fair prices. You can use a similar no arbitrage argument, but it's not unique. The price of an option depends on the volatility, so different volatility models give different option prices. So how do we price an option given some sort of volatility model? Well, if you have a complete market, that means that if you draw any payoff profile you like, it could be not this standard call option payoff, which is just the maximum of S minus K and 0. It could be, look like the skyline of Manhattan with skyscrapers and funny shaped buildings. So any payoff profile you like can be replicated using tradable assets or instruments. So that's what we call a complete market. So for any option, doesn't have to be a standard call or put. It could be a very exotic option with strange payoff profile. But as long as the market is complete, we can add other traded assets or instruments to get a portfolio that is risk-free. In other words, we can perfectly hedge the option. And in that case, if you've got a risk-free portfolio, the expected return is the risk-free rate. So this portfolio, which is risk-free, will have the same value whether I'm very risk-averse or risk-loving or risk-neutral, because there's no risk. So this risk-free portfolio has the same value for all investors, regardless of their attitudes to risk. And the other assets in the portfolio have market prices, so there's no argument about what their prices would be. But for this exotic option, where there isn't a market price, what I can do is to use a risk-free rate of return for the entire portfolio, use the value of the hedging instruments that I can see, and then deduce the value of the option for a risk-neutral investor. I could do it for a different type of investor, but I might as well assume the investor is risk-neutral because they all have the same value. They wouldn't differ according to their attitude to risk. So that's why we talk about risk-neutral measures. So what is a measure? A measure is just like a sort of probability density. And in particular, we are interested in the expected value under the measure. So a risk-neutral investor's beliefs about the price of a risky asset are, we have an expected return, which is the risk-free rate, but there's also, because it's risky, a distribution around that expected return. And that's called the risk-neutral measure. And then the fundamental theorem of asset pricing comes from the famous work of Harrison and Krebs back in the 1980s, before the Black-Scholes paper in 1986. And they showed that in a complete no arbitrage market, there's a unique risk-neutral measure. We can call that Q. Now, sometimes holding the underlying, not Bitcoin, but if I were holding Tesla, I would periodically be paid a dividend. And as I said before, we'll be calling the dividend yield Y. Or if I were holding the underlying, say, corn in a warehouse, there would be transportation or storage, or what we put them all together, and we call these carry costs. And it's a cost. So in this case, this Y is negative. Now, if you look at the price of Tesla, if I'm holding the Tesla stock and I look at historical prices of Tesla, maybe download them from Bloomberg or whatever, these don't periodically suddenly jump up every time somebody's paid a dividend. These are ex-dividend prices. So I actually, if I'm a risk neutral investor, I already get part of my expected return from the dividends I get. And the rest of it needs to come from the expected return on the price process for the underlying. In other words, under a risk neutral measure, the drift in the price process should be R minus Y times dt. So how do we use the risk neutral valuation argument to find the price of an option? Not just Black-Scholes, but any sort of payoff this formula applies to. So the risk neutral option price at some time t before expiry will just be the discounted time t expected payoff under the risk neutral measure. So you would, in practice, if you didn't have a closed form or an analytic formula to apply, you would simulate the price process from time t until capital T, and that would give you a distribution. And then you calculate the payoff for every one of the simulations. Some simulations would mean that the option ends up not paying anything. Others, the option would be very valuable. So you compute your payoff using that distribution, and then you calculate the expectation of it. And you can do that under the risk neutral measure or using any stochastic volatility model you like. That's what we call the pricing measure. So you can assume something like a Heston model, calibrate its parameters to market prices of vanilla options, and then use a simulation method, if you like, to compute the model price of some more exotic sort of payoff. So the popular volatility models, like obviously Black-Scholes, although that's not a model that any trader would use in practice, more likely use some two-factor Heston or affine type vol-of-vol model. But most of the models that are used in practice would yield a closed form formula for the price of, at least for a vanilla option, because that makes it much easier to quickly calibrate. Otherwise, you've got to simulate for 10,000 or 100,000 simulations many times to recalibrate your model. So we calibrate to those European options, and then we get our model parameters. But I'm not going to go into that. This is not a course on option pricing. This is about trading and hedging Bitcoin volatility. So I'm just going to go over the Black-Scholes model because we do need that to understand implied volatility. So this is the Black-Scholes model. It assumes the underlying follows a geometric Brownian motion, and a geometric Brownian motion can have any drift here, but I'm putting in the risk neutral drift because we'll price the option in the risk for a risk neutral investor. And the important term is this sigma here. That is the volatility. Another way of writing this, and we'll use this later on when we look at the VIX, the Bitcoin VIX, is to integrate and, as seen from time zero, this log of, this is, if you integrate this, you get the log contract. In fact, this is the payoff of the log of ST over S0. And because this is a Wiener process, the distribution will be normal. This minus a half sigma squared comes from using Ito's lemma. So it will be normal with this expectation and sigma squared t for the variance. This we'll see coming in various guises. It's the square root of time rule for in discrete measure when you're looking at market risk scaling. It's also going to come into the next formula for moneyness, which I'll go through in more detail. The first definition I gave of moneyness was very loose, just talking about in the money and out of the money options. And another way, of course, of writing this log returns are normal is that the price is a log normal distribution with these parameters. And so I call it the Black-Scholes Merton formula. Some people just call it the Black-Scholes formula. The papers by Black-Scholes and Bob Merton were published separately at the same time. The Bob Merton paper was much superior, but Black-Scholes were published and in a journal that got more attention. So anyway, that's why I call it BSM, or Black-Scholes Merton. And this, under the assumption of geometric Brownian motion, we can derive a closed form formula for the option price using risk neutral valuation. And this gives us the price of a call and the price of the put as in a form that I'm sure you'll all be familiar with. I don't use capital N here. N is the notation for a distribution function. What we have here is the cumulative distribution of capital Phi, the sigmoid shape curve, okay? It's not just, yeah, there's a lot of confusion about how these things are written. And so the variables D1 and D2 are the important parts. That's where the volatility comes in. Everything else we can observe. We know what the underlying is at the moment, assuming it's traded. We can look at the Bloomberg screen. We know what the strike of our option is. It's written on our ticket, and so is the maturity. We should know what time it is and the risk-free rate and any dividend yields. What we don't know are the D1 and D2, and they reflect what we call the log moneyness. Down here you can see what D1 and D2. So if we define the moneyness a little bit more precisely now, as a ratio of the underlying to the strike, but both discounted at different rates. This is a convenient way of writing it. Just comes out that way in the Black-Scholes formula, that if we take the log of this quantity here and call it little m, that's really what dominates the value of D1 and D2. So the moneyness is greater than 1, equal to 1, less than 1, depending on whether a call or put option is in the money or out of the money, and so forth. We've already gone through that. So the log moneyness is going to be greater than 0 or less than 0. So sometimes when you look at implied volatility surfaces, you could have a strike along the horizontal axis, but I normally draw them with moneyness because strikes change all the time. The strikes that are traded this week could be completely different to the strikes that are traded next week or next month. But the moneyness, you know, you always get a balance of options either side of at the money. So moneyness is something that gives you a much more consistent picture of what's happening. So D1 and D2, this is D1, it's the moneyness all sort of standardized by its standard deviation. This is the square root of the volatility, square root of the variance in the distribution for log returns. And you either take off or add sigma square root of capital T minus T over 2, depending on whether you want D1 or D2. But really, when the option is at the money, D1 and D2 are going to be very close to 0. And that means they're going to be, that the phi values here will be pretty close to 0.5. D1 is always going to be a little bit less because we take off sigma square root of T. But they're both close to, sorry, D2 is going to be less than D1, yeah. All right, so this next section is going through implied volatility smile surfaces. And here you see a picture of implied volatility, which is a function of capital T and M that we back out from the market prices of call and put options. Just like that matrix that I showed you for calls. Let me quickly go back there. Actually, I think I might have repeated it here, did I? No, did I? Sorry about that. Let me just go back to this. So there's very little trading in the money calls, at least on standard assets. There's a lot more on Bitcoin, and we'll talk about that later. But these options have very low volatility. So at any point in time, those prices are likely to be stale. And so in order to get an accurate picture of what's happening in the market through your implied volatility surface, we tend to take the high strike calls, the out of the money calls, and the low strike put prices. And that's what you get for your implied volatility surface. So this just shows time to maturity, up to 2.5 years. That's the sort of maturity you would only get on very, very heavily traded options like S&P 500 ones. And then this moneyness is S over K. It's a very simple form of moneyness. So most of the moneyness is in the out of the money puts, a little bit on out of the money calls, but not much. And so the shape of this surface, obviously it's not a surface like this. We have to use various interpolation techniques to get a surface. It's something that can be explained by the way that traders behave. And first of all, let's just talk about transformations of option prices, because implied volatility surfaces are just one way that you could transform option prices. They're used for all sorts of other things as well. For example, you could transform them into what we call a local volatility surface. And that would give you directly a model, which a lot of traders like, as opposed to the Black-Scholes model. Here, you just put your local volatility term there that you calibrate from option prices. Or it could be used to get a set of implied densities, which can be used for all sorts of theoretical derivations, including the sort of derivation that I'm going to go through just for the VIX formula. But you can also derive higher moment formulae using implied densities and all sorts of other applications. So we're just going to put R and Y to 0 in this section just to make it a bit easier. So what is the market implied volatility? There's a market implied volatility. There's also a model implied volatility. But let's just talk about the market implied volatility. So to obtain a Black-Scholes model option price, and implied volatility is always derived based on some model, and almost always it's the Black-Scholes model that that we have. So you need to forecast some single average sort of value for sigma, and that represents the average volatility over the life of the option. The other parameters in the Black-Scholes model, like S and R and Y, and the parameters of the option T and K, are all observable. But everything else we can read apart from this sigma. We don't know the average volatility. What we observe is just the market price. So what the market price implies is a sort of average volatility over the life of the option that all the traders in the market expect. So that's what the implied volatility is. It's the sigma that equates the Black-Scholes price with the market price. Now, we could also look at a model implied volatility. Let's write the market implied volatility. I like the term, the function small theta. So that would be the implied volatility of a particular option with characteristics K and T, given that the underlying is currently at the price S. So that's the constant volatility, which equates the Black-Scholes price to its market price. But we could also look at a model price and equate the model implied volatility to the model price. So I won't go through, I haven't gone through the put-call parity relation, but that just shows that the difference between the price of a call and put of the same strike and maturity is independent of volatility. And for that reason, calls and puts, even if you use in the money and out of the money at the same time, if the market prices are not stale at all, you should get the same market implied volatility. And particularly near at the money, you could get some active trading around there, particularly if the option is not too long maturity, and you should get an identical implied volatility from call and puts. But as I said before, we tend to use the out of the money ones because those have more trading. So given all those different strikes and maturities, we have an implied volatility surface such as the one I just showed you. And the features such as this, I mean, if we slice through any particular time to maturity, we have a sort of smile shape, which is particularly pronounced on the short maturities. But it's not exactly a smile. It's some people call it the smirk. That's the American name for it, because instead of a symmetric smile, you've got a sort of smirk like that. So that's what we call the skew. In equity options, sometimes the skew is so pronounced you can't see any smile at all. But generally speaking, cutting through it looks like a sort of like a hockey stick with very high implied volatility for the low strike or the out of the money puts, which is much higher than out of the money calls. And the other thing is that the term structure flattens out so that you don't get nearly so much of the skew at longer maturities. So you could have a term structure slicing through a single moneyness where you've got a sort of backwardation that levels off or a contango that levels off. So the market price we're going to call FM, and the implied volatility is sigma K and T. And to find it, we just use any sort of optimization, like, you can do it in the Excel solver if you like, any numerical method by putting in the Black-Scholes formula here, equating the Black-Scholes model price to the market price, and then changing this so that the two are identical. So the objective, if you use something like the Excel solver, will be just the difference of these two, or their difference squared. And then you would set that to 0 and then back out the implied volatility. That's how you do it. Once you've done that, you need to interpolate over the whole surface. So we interpolate over moneyness, and we also interpolate over maturity. For the moneyness interpolation, we would generally use something like a shape-preserving interpolation, particularly if we have to extrapolate to the tails where there's very low strikes or very high strikes where there's no trading, or if there is trading, it's stale. So in order to get a sensible surface, one would use a cubic Hermite spline or piecewise cubic Hermite spline or something like that. So we do that over moneyness, as I said before. The strikes can change over time. In the maturity dimension, the interpolation should not be over the implied volatility. It's much better if it's over implied variance, because it can be more linear that way. The reason for that is that if you have a Wiener process or anything that's independent, an IID process, then variance is additive. If you look at variance over the next day or the next 2 days or so forth, so the variance of 1 day returns and 2 days, so variance of a sum of consecutive log returns is additive. So that makes it easier to use a linear interpolation over variance. So whenever you need to do that interpolation, and you do need to do it when we look at the Bitcoin VIX formula, that interpolation would be using the square of the implied volatility and then a linear interpolation. And once you've got your surface, you have to make sure that, that you haven't got any strange behavior of the delta. The delta of an option should be, that's the first derivative, should be increasing for a call and always decreasing for a put, otherwise there'd be an arbitrage. So we almost always find that the market price for all options gives us a surface that is not completely flat. So the Black-Scholes assumptions that there's one single constant sigma, which should be the same for all options, independent of the strike and the maturity, is obviously not believed by the traders in the market. So, as I said, the smile very often has a negative skew, particularly in equity markets. The behavior of Bitcoin smiles was quite odd at the beginning, I have to say. It seemed to have no ball. Okay. So going back to, yes, I thought I'd repeated this, this matrix of call option prices, a similar one for put. We get an implied volatility surface. That's the one that we get from this particular set, because the maturity goes from 40 to 150 days. And this is just a test set that I use for teaching, where by interpolating, backing it out, you can do most of that just using Excel. You should get an implied volatility surface looking like this. So why do we get this smile shape? This, in fact, this is a very strong skew, but it's more of a smile here at the longer maturity. Sorry, this is longer maturity here. That's more of a smile, but this is a smirk at the shorter maturity. So I've interchanged the moneyness and the maturity compared with the previous surface. Well, the market obviously doesn't believe the assumptions of the Black-Scholes model, and in particular, they believe that log returns are not normally distributed. They are heavy-tailed. So that means that out of the money options have more chance to become in the money than the Black-Scholes model predicts, because you have more weight in the tails. So large price moves, either up or down, are more likely, that's what the traders believe. And that gives more value to deep out of the money or deep in the money options. So whereas the Black-Scholes model would give a model price of 0, traders actually can sell these options for, in some cases, particularly when people are quite frightened of for example, an imminent crash in a price, they are going to try to buy deep out of the money puts. They're very cheap. They may not have a price of 0. In fact, the more people that demand those out of the money puts, the higher the traders' price will be, because traders set their prices by supply and demand. And so you can get quite inflated prices for deep out of the money puts when investors are really nervous. For all we know, Elon Musk might have a lot of out of the money puts on his own company, because, if Tesla was suddenly to, I don't know, some terrible scandal were to emerge and the whole company were to collapse, at least Elon Musk would be able to sell his shares at the price of the put. So it's a very, out of the money puts are great hedging instruments for people that are long the underlying shares, but also they become instruments for speculation because they're so cheap. And people at the moment who think that the Bitcoin price is going to crash could pick up an out of the money put very, very cheaply, and then either sell it again in the secondary market. As the price goes down, that out of the money put will increase in price, so you can just sell it on. Or they can wait until the price goes below it, and as I said, most options are not actually cash settled at maturity. The volume, everything goes back to the issuer, generally a few days before expiry. But there are in Bitcoin some very short, 1 day, 2 day options now. It's a completely different type of market, which I've yet to study myself. As I said on Tuesday, I have an awful lot of problems that I've not yet got onto on Bitcoin. It's just, and other crypto. Anyway, so when you have these very high price out of the money puts or other options, the only way that the Black-Scholes price can match this very high market price is to increase the volatility. That's the only parameter that you can change in the Black-Scholes model. So that's why implied volatility goes up when the market prices are higher than model prices. So the skew is really a feature of fear. I've already told you about insurance offered from puts from risk-averse investors. I went ahead in the slides. So we didn't really have a skew until after the first Black Monday in 1987. The options started trading around the early 80s, and then we had the Black-Scholes model, and then because of all that derivative trading, we had the crash in global crash in equities, and since then we've had this skew, which represents the fear in investors. Okay, so what time am I now? 11:20. I'll carry on for another half an hour. Probably to the end of this section, and then I'll take questions. So an option is a trade on the underlying price and also the implied volatility. One way that you can isolate the directional trade, in other words, a trade that gambles also on what the price is going to do, is to buy something called an at-the-money straddle, or sell an at-the-money straddle. So the payoff to a call we've seen is flat until K, and then there's a 45-degree line after that. And the payoff to a put of the same strike is, and we'll take the same maturity, of course, so that we're matching the characteristics. If you get an at-the-money put and call of the same K and T, there's a sort of V-shaped payoff. So that means that you will make money provided the underlying goes up or down. It's not a directional trade. So suppose you buy that and then the price moves the next hour or the next day. Well, then it's no longer at the money. There's still the directional side of it. So in order to use straddles to trade volatility, you have to keep rebalancing them, which is quite costly because options they tend to have much bigger spreads than futures. So the reason that variance swaps became very popular in the 1990s is that they are relatively inexpensive, pure volatility trades. And since variance swaps started trading, they're over the counter, or for Bitcoin, the variance swaps are what we call on-chain. Okay, they're not, at the moment, they're not traded on the derivatives exchanges that I talked about on Tuesday. In fact, we're on the cusp of getting some derivative products on Bitcoin VIX, but we only developed the Bitcoin VIX and started quoting it in December. So, you know, we still have time to go before the exchanges start listing Bitcoin VIX futures. But just as the S&P 500, the original VIX that the CBOE started quoting back in the beginning 1992, I think it's changed its methodology later. Once you've got anything quoted, whether it's rainfall or temperature or VIX, as long as it's quoted and you can all agree on what the quote should be, then you can have a futures contract on it. And once you've got futures, then you can have options on it because the option is priced from the future. The futures, being the most liquid, are the hedging instrument. So as long as you've got a hedging instrument for an option, then you can. So anyway, the whole spectrum of Bitcoin derivatives is just on the cusp of those Bitcoin volatility derivatives, I mean. Okay, so question is, why would we want to trade volatility? Well, there's lots of reasons. First of all, it's diversification. Equity volatility is highly negatively correlated with equity price, and the same for lots of other assets. So in other words, when the price of a stock goes down, we talked about this leverage effect on Tuesday when we looked at the asymmetries in Garch models, and in particular the asymmetry that comes in the specification of the conditional variance equation, not the innovation. The asymmetry comes from the fact that when the stock price falls, its debt to equity ratio increases for the company. It's very difficult to get debt quickly. So for a while, to get more debt, you know, to issue bonds or to get loans, that takes a while. So if there's a big drop in the equity price, then analysts start looking at that indicator as something that that is not a positive indicator, let alone the book to market values at the moment. In the US, that's something else, but that's another topic. But anyway, so analysts start giving sell recommendations, and the price goes down more. And so that's why when the price goes down, equity volatility goes up. Volatility is also a hedge. If you've got an option that's, that has a very large vega, so that could either be a long-dated option, they have much bigger vega than short-dated options have very little, or forward start volatility. For forward start options, you would have to trade a forward volatility. So because if you can trade volatility in derivative products, you can trade the curve of volatility, and you can actually trade the forwards curve to get forward volatility trades for forward start options. And you could arbitrage volatilities on different underlyings. You could buy and sell those, as the introductory speaker, I didn't actually get his name, was talking about. If you're not sure about what to do, just trade the basis or trade arbitrage. That's the sort of thing that you might want to do. Or you could just take a directional pure bet on what realized volatility is going to be using a variance swap. So the variance risk premium can be defined in many ways, and I'm going to be talking about the model-free approach to trading the variance risk premium. But there's another approach using stochastic volatility models, or stochastic volatility jump models, as most people would use nowadays. Jumps in the underlying price, maybe not the volatility, are actually quite important, particularly in Bitcoin. So you'd add an extra Poisson term to the mean equation that I showed you in the Black-Scholes model. Anyway, so we can define the variance risk premium as the reward required by a risk-averse, because it's risk premium, okay, so risk-averse investor, to compensate for the risk of stochastic volatility jumps in price of the underlying asset. You can decompose your variance risk premium into the diffusion part and the jump part, if you like, but the only way you would be able to do that would be to calibrate your stochastic volatility jump model two ways. Calibrate in the to option prices, and then you get your parameters one way. But also you could, we normally use the word estimate in this case rather than calibrate, in the physical measure, just as you would estimate the parameters of a Garch model. So you discretize your continuous time stochastic process, and you'll use some econometric techniques like the particle filter, the Markov chain Monte Carlo, as I was mentioning on Tuesday, using just one set of historical prices for the underlying. So it's two ways. One, you use a snapshot of option prices, the whole matrix now, or you use, in the physical measure, a time series for the underlying. So, and then you can attribute this variance risk premium to the different features. It can be something to the mean reversion speed, the jump, the long-term volatility, if you've got a two-factor model for vol of vol, just by taking the difference between the two parameter estimates. And there's a huge literature on this, but I'm not going to go into that. I'm going to focus on the model-free approach. And this approach measures the variance risk premium by equating the variance risk premium to the expected profit and loss on a variance swap. So a variance swap is a swap of variance for measured in two ways, in the risk neutral or implied measure and the physical measure. So just as this risk premium would be measured using parameters in the implied measure from the market price and the physical measure from the underlying. Here we have two variances. We have a realized variance, which is measured over the life of the swap, which would be defined, typically it's the sum of the squared log returns over the life of the swap, which could be daily, it could be hourly, it all depends on the maturity and how rapidly the underlying moves. And then you've got a fixed variance swap rate. Now, the variance swap rate we can imply in a risk neutral measure, but as with anything in the market, assuming the variance swap is traded, if you the traders will set whatever variance swap rate they can get. Okay, so they are set by supply and demand. So that's the market variance swap rate. You can get a model variance swap rate as well, which is based on a model-free formula. And that's what the VIX formula is. It's a fair value of a variance swap. Okay. So this fair value variance swap rate doesn't depend on the specification of the model for the underlying price and volatility processes. That's why we call it model free. But it does. I mean, the original formula was based on Black-Scholes, and then there's been a lot of work by people like Peter Carr and so forth on what's the difference if you add jumps, you know, the jump error, which is supposed to be very, very small. But this all stems from the definition of the realized variance as the sum of the squared log returns. If you changed that definition of realized variance, then you wouldn't have any error at all for any process. It really would be truly model free. Maybe at the end, either the end of today or the end of this morning, well, it's nearly lunchtime, but I will point you to some research in that area which goes into more detail, but I simply don't have the time at the moment to elaborate on that. So this red thing here is the payoff to a variance swap. This, the payoff actually depends on the market, the trader's swap rate. Okay, so let's just go through from the top. The exchange's realized variance, which we call R, with a fixed swap rate, KT, and the payoff is just the difference between them. So it's a swap. So it has to have a notional. So, you know, this would be, for example, per dollar per percentage point. Okay, so we usually measure, we quote these rates as percentage, as volatilities, but it's actually a variance swap. Variance swaps are linear in payoff. They have a very nice convexity property, which volatility swaps don't. And so that's why they've really taken off rather than you can get volatility swaps, and you can also arbitrage between variance and volatility swaps. But this variance swap, even though you'll see variance swap rates quoted as percent, to put them in the formula here. And we can fix a fair value so that at time zero, at the initiation, that swap rate gives you an expected payoff of 0. That's how we would get any swap rate, including the fair value of a variance swap. Of course, the market swap rates are different from fair value swap rates. It may be at initiation, the markets are particularly volatile, and selling realized variance is something that traders want to do, and so the market swap rate would be lower than a fair value, or the other way around. During excessively volatile markets, that's where we see the difference. There's quite a high demand for variance swaps as a diversifier of equity risk. So quite often we'll see something like 5% difference between market swap rates and model swap rates, fair value swap rates during volatile markets. So in this case, once we've got the variance swap, we can define our variance risk premium, and each risk premium, there's a whole curve of risk premia, so it has a particular maturity associated with it. it can be defined as the payoff to a long position on a variance swap of maturity T. Now, usually it's small and negative. In other words, the writers of variance swap who will be selling realized variance in return for a fixed swap rate would be making a very small profit. It's a bit like writing out of the money puts. These insurance type products tend not to be exercised, or they may not end up being in the money, but it's still an insurance that might be in the money, so there's still quite a high demand for it. And before a period of unexpectedly high volatility, the variance risk premium can become very, very high and positive. So the problem is that writing variance swaps is much more risky than writing out of the money puts, which is also a risky business. So we'll be having a look at some of the variance risk premium on Bitcoin to see quite how risky it is. But we'll be doing that later on today. But just to consolidate what I'm talking about with a variance swap, because it's fundamental for the next section. Suppose you've got a 30-day variance swap rate, which is 18%. Okay, so you've been quoted 18% if you want to buy realized variance. And suppose that you expect 30-day realized variance to be 20%. You have to have some expectation. The realized variance is looking forward. You know, you can only ever measure it ex post. It may be measured in the same way as an historical variance or volatility, but it's looking forward. So you can only have an expectation of what you think it's going to be. What is the expected payoff to a long position of 100 per basis point on this swap? Per $100 per basis point. So that's why this notional amount is 10,000. And the expected payoff would be the realized variance minus the swap rate as a variance. In other words, it would be this. And the terms of the conditions of the swap will specify exactly the day count convention for these annualizations, because when you quote them, they are annual. It's not 18% over the next 30 days, it's an annualized percent. That's the standard way of quoting them, so that you can compare them of different maturities. So I mentioned before the log contract. So this of some maturity T now, not the running time T, the normal distribution for the log return. I'm now looking at what Anthony Neuberger called the log contract. So this payoff, log ST minus log S0, has a logarithmic shape, okay? And Neuberger showed that if the underlying price follows a geometric Brownian motion, then the expected payoff to a short position on the log contract is the continuously monitored realized variance. In other words, normally you would take a discretely monitored realized variance, you could add the additive property of variance of the log return from today to tomorrow, from tomorrow to the next day, and so on and so on. You would add up all those one period variances because of the IID property. But if you do that continuously, then you would integrate these variances, okay? Now, the fair value swap rate is the risk neutral expectation of the discretely monitored realized variance, not the continuously monitored. So our fair value is going to be based on this, whereas what we really want is the discretely monitored realized variance, the sum of the squared log returns. That's how it's defined. So there is what we call a discrete monitoring error in this formula. Another reason why the later work that I can point you to, what's called a generalized aggregation property, will be much better because there's no none of these errors occur. So we can only get an approximate formula, but it's model free in the context of geometric Brownian motion with a tiny little bit of error because there may be jumps. So I don't really like to use the term model free in this context, but that's what it's normally called. So what we need to do is to replicate the payoff to a short position on the log contract. That will give us a fair value for the continuously monitored realized variance, which is approximately the same as the fair value of what we want the discretely monitored realized variance. So how do we replicate the payoff of this sort of log contract? Well, there's something called gamma replication. So you can draw any contract payoff you like. It could be like the Manhattan skyscraper profile, if you want. And what you do is, for example, if it was just this sort of payoff here, the line continuing with slope S1, all you need to do is to buy S1 calls, because one call will have slope 45 degrees. But if the slope is twice that, then you would have two calls, and that would give you a higher slope, or you'd have half a call, which would be a lower slope. So you buy S1 calls at strike K1, but then if the slope changes, then you'd have to buy an additional, this slope is the delta of your profile, and this additional increment is the gamma of your profile. It's the change in the delta, and that's why we call it gamma replication. So you buy an additional gamma amount of calls up to this strike, and then so you keep adding a gamma of your profile in terms of the number of calls. You could do it using puts. You don't have to start down here. You could start at the middle, and there are lots of different ways you can do gamma replication. Normally, one would use the out of the money options because they've got more reliable prices. So the replication of the short log contract would be a gamma replication. So this result goes back to Carr and Dilip-Madan, Peter Carr and Dilip-Madan, using vanilla calls and puts. So at time 0, the replication portfolio would be your gamma times that increment in strike. And this is the value of the option that you buy. So what is the gamma? That's what we need to know. Well, the payoff to a log contract is differentiating the log of S is 1 over S, and differentiating it again, it's minus S to the minus 2. So for a short log contract, the gamma is S to the minus 2. And if we set these strike increments usually to be, because you don't always have equal increments on strikes, it may be that you don't have enough liquidity to use all the, although strikes might be quoted at regular increments, you might not have liquidity at all of them. So that's what we would use. So the replication portfolio would be this strike increment, which is a half times the strikes either side of where the gamma is. This is the gamma at that value of S, Ki, and this is the price of the option. I'm using little k for the strike here. Previously, I used capital K. Okay, so that's the replication portfolio for a short log contract. And that's basically going to be the VIX formula. So this slide, as you know before, we can look at the geometric Brownian motion using Ito's lemma. I've kept R in there, not Y. There could be R minus Y here, as I had before. This is just following Neuberger's derivation. Integrating, as I did before, will give you this term here. In other words, what we want is going to be twice times r, because, you know, just turning this around, I'm sure you can all follow the mathematics here, minus 2t to the minus 1, this thing that we know, plus 2 times the integral of sigma dw, but this is a Wiener process, so if we take expectations under the risk neutral measure, that's what we need to do to get a fair value. This term goes away, and so this is what we're going to get. So basically, V gives us what we need, with a little bit of adjustment if we've got non-zero interest rates, and multiplying by 2t to the minus 1 as well. In other words, this. Okay, so this is our fair value for a continuously monitored variance swap. Now substituting in this value for V, this gives us this formula here, which is what you'll see on the white paper for VIX, or the white paper for the Bitcoin VIX that I wrote as well when I, but I didn't derive it. It's not derived in the VIX CBOE either, as far as I know, but you can find it in papers by Neuberger and Demeterfi, and the Goldman Sachs groups like Emmanuel Derman and so forth. All you ever wanted to know about variance swaps but never dared to ask. That's where you can find the nicest derivation. Anyway, I've done it for you. It's also in my books, volume 3. So these options are going to be out of the money options because then prices are more liquid. And so what this formula will give us is the VIX and lots of other volatility indices. It's quoted as an annual volatility, and it's the 30-day fair value variance swap rate for the S&P 500 index. Whaley published a paper on this back in '92, I think, in the Journal of Portfolio Management, where he called it the investor's fear gauge, because it represents the implied volatility smile on the whole smile. You see, you're taking all the options. So there's one number that it's better than at the money volatility, because of the smile, at the money volatility is not a good picture. But if you want to encapsulate everything in one number, the higher the skew. Out of the money put options here, because we're going to divide by the square of the strike. Low strikes have a much higher weight than the high strike options in this formula. So it's one number, but it's very much dominated by the skew. And that's why it's called the investor's fear gauge, because we know the skew gets deeper as investors get more nervous. Now you can get variance swap rates for many, many stock indices, not only stock indices, but also the exchange rates, bonds, interest rates, swaps, and all sorts of other underlyings. But and now there other people are deriving Bitcoin VIX, but I was the first to do it, so that's why that was the first to go public. And the challenges that we have to do it on Bitcoin is nothing like the challenges that, and I also, with one of my PhD students, built the first VFTSE index, and we also did skew indices and kurtosis indices, which if I have time, I might show you. Let's have a look. Just gone over a little bit over. So I will stop here and hopefully take questions. Hi.
Okay. Hi. Many thanks, Carol, for the nice talk. And now we have time for questions, more or less 15 minutes. So